Hi there, I'm Steve Higgins.
And I'm Schmidt, and we are the financial advisors and partners at HD Wealth Strategies.
Right, and here we are in the midst of the volatility event caused by the spread of the coronavirus. The S&P 500, down as much as 28%, is evidence of the uncertainty that is gripping our country right now.
Just 1 month ago, stock indexes were setting all-time highs. The speed of this downturn is historically fast. However, in terms of severity, we've seen volatility events much worse than this. And while each event is unique in its own way, what is consistent is that we've seen conditions improve and ultimately fully recover every single time.
Right, and what we need to focus on is perspective, the use of a process, and we need to proceed with poise.
And history shows us that over time, U.S. stock markets provide consistent returns. However, a closer look shows that over short periods of time, the markets are less predictable. The stock market functions as a pricing mechanism for companies. Over time, the market can make sense of all of the information available to it. But in the short term, the markets struggle to determine prices in the face of unexpected events, such as the coronavirus.
Right.
In the past, we've seen short-term, severe market disruptions. Let's take a look at a couple of those and those events and kind of see how those have played out over time.
October 19th, 1987, known as Black Monday, saw the Dow Jones Industrial Average drop by over 22% in just a single trading session. The crash, caused by a massive amount of trading, seized the stock exchange computers, causing a spiral that some felt would lead to global financial ruin, and whispers of the next Great Depression spread through both Wall Street and Main Street. While paranoia dominated the short term, rational thinking eventually returned, and the Dow Jones Industrial Average was up 23% over the next year. 3 decades later, the Dow is up over 1,100%. $100,000 invested on Black Monday is worth over $1.2 million.
April 3rd, the year 2000. A judge ruled against Microsoft in a landmark antitrust case. That was the first domino to fall in the dot-com bust. By May of 2000, the NASDAQ was down almost 40%, on its way to a staggering drop in value of about 78%. The shockwaves of the tech bubble bursting shook the foundation of our markets, leading to massive declines in values across all the major stock indexes. With the markets already staggering, America woke up to the nightmare of September 11th, which struck at the hearts of all Americans and specifically at our financial system. The stock market closed 4 days, and in the dark moments to follow, many questioned the resiliency of our system. The S&P 500 was down 50%. The S&P 500 since then is up 121% since September 11th, 2001. And the NASDAQ is up an amazing 327%.
October of 2007, the S&P 500 notched an all-time high that would stand for over 3 years because of the impending market correction that was about to happen. After the demise of major investment banks like Lehman Brothers and Bear Stearns, and the rescue of countless other financial institutions, the belief in our financial system was shaken to the core. The unemployment rate was above 10%. We call this generational event the Great Recession. On March 9th of 2009, the S&P 500 bottomed with the index down over 55%. Since March 9th of 2009, the S&P 500 is up 275%. $100,000 invested today is worth over $275,000. During volatility events, we are often presented with the question, what do we do during the chaos? Essentially, people want to know, how do we make the pain stop?
At HD Wealth Strategies, we adhere to strict processes that manage volatility events before they happen. First, as a part of that process, we have detailed and thoughtful conversations with our clients at the very beginning of relationships. We establish a personal investment policy that aligns our clients' long-term goals, resources, and expectations.
And we have honest conversations about the reality and expectations of volatility events and how emotions can impact the investor's ability to stick to the plan. Continuing the process, we regularly review the risk profile of our clients and adjust goals and their resources to keep the plan and the client up to date.
As part of our investment process, our diversified portfolios are created in a way that keeps a certain percentage of a portfolio invested in asset classes other than stocks. These asset classes, such as bonds and alternative investments, create non-correlation in the portfolio, so that in times of volatility, each investor will have the appropriate amount of liquid assets to fund any short-term cash or income needs.
Right, and as the market moves up and down, we rebalance our portfolios to keep our clients invested in the original allocation as defined by the personal investment policy. For example, just 6 weeks ago, the stock market was setting all-time highs. With the S&P 500 10% higher than the previous all-time high, we sold a percentage of stocks in each of our model portfolios and repositioned those assets into short-term bond investments, essentially reducing market exposure and risk across the board.
And then by the end of February, the stock market began to experience significant volatility. While it seemed like chaos was winning the day, we once again prepared to reposition assets. As part of our predetermined process, we repositioned a portion of low volatility assets back into high quality stocks when the S&P crossed the 10% down threshold. Just 2 short weeks later, the S&P crossed the 20% down threshold, and we once again repositioned a percentage of liquid assets into high quality stocks, sticking to that plan.
Certainly nobody is enjoying the volatility. However, having a process and strictly adhering to the process will give our clients and their ability to reach their long-term goals a significant advantage.
And there's no way to know when this is going to end. We certainly aren't in the business of making predictions. What we do know is that this will end. And those people who went into this volatility event, just like every other volatility event, with a plan and a process, will be far better off than those who didn't. And that is why it's important that we need to have an honest conversation with you.
We spend a lot of time discussing goals and developing strategies with our clients. We talk about the emotions that can impact success, and we use history to help guide our clients and their understandings of volatility.
All of this requires you, our clients, to stay poised during the volatility event. We've had good conversations with clients over the last 2 weeks, and it's clear that our clients are committed. This volatility will persist for a while, and there may be a time when your patience and pain threshold are tested. Remember, you have the knowledge and perspective to guide you.
We have powerful processes to prepare and navigate volatility events just like this that will help you stay on track to meet your goals.
You are prepared. We can assure you that we are engaged and focused on leading the way through this. We will continue to proactively update you along the way and certainly have the capacity to address any concerns you may have.
We encourage you to be diligent and take care of yourself and your family. Our nation certainly faces a challenge right now, but we believe in the ingenuity of this country and our undeniable ability to work the problem. Thank you.